Ladies and gentlemen, on behalf of Kaptify Consulting Investor Relations team, I welcome you all to the H2 and FY26 post-earnings conference call of JB Laminations Ltd. Today on the call from the management team we have with us Mr. Mudit Agarwal, Managing Director, Mr. Subhash Raghav, Chief Financial Officer, and Ms. Aarti Chauhan, Company Secretary. As a disclaimer, I would like to inform all of you that this call may contain forward-looking statements which may involve risk and uncertainties. Also, a reminder that this call is being recorded. I would now request the management to brief us about the business and performance highlights for the period ended March 2026, their growth perspective and vision for the coming year, post which we will open the floor for Q&A. Over to you, Mudit.
Am I audible?
Yes.
Good afternoon, everyone. Thank you for taking out time to join this call today. My name is Mudit Agarwal. I'm the Managing Director at JB Laminations Ltd. And on behalf of the company, I'm pleased to discuss the performance of the company in FY26. While the entire year remained more challenging than anticipated, we laid the foundation for multiple long-term growth drivers for the company. We strongly believe in the long-term growth story of the Indian power sector and aim to capitalize on this growth in the most sustained manner. We firmly believe our integrated approach of manufacturing CRGO cores and transformers, combined with turnkey projects in the power and transmission and distribution sector, will help us scale efficiently, organically, and profitably in the long run. Some financial highlights of the year were as follows. Total annual revenue stood at rupees 329 crores in second half of the year and rupees 549 crores for the whole year, representing nearly 50% growth both sequentially and on a full year basis. A meaningful 25% of the total revenue share came from the EPC projects business, contributing to rupees 141.5 crores revenue. EBITDA, however, declined to rupees 34 crores in FY26 compared to rupees 43 crores in FY25 due to a decline in H1 of FY26, which was at rupees 10 crores. However, it jumped back to rupees 23.9 crores in H2, increasing from rupees 10.2 crores in H1 FY26 and rupees 20.1 crores in H2 FY25, with a sizable chunk coming from the EPC projects division. Consequently, profit after tax also decreased to rupees 18.2 crores in the current year from rupees 25.4 crores from the previous year, while it increased on a half-year sequential basis from 3.68 crores in H1 FY26. The annual decline in profits resulted mainly from continued volatility in the CRGO business. Excessive imports from China caused multiple sharp declines in raw material prices, creating an oversupply in the market and difficulties in planning. Raw material prices fell by a staggering 30 to 35% from March 2025 to March 2026, causing extreme volatility in the supply chain. Given the largely non-differentiated nature of the CRGO steel processing business, the entire industry faced pressure during the whole year, including supplier steel mills such as JSW and NLMK. For us, this eventually led to a decrease in gross margins and an increase in fixed cost as a percentage of sales, which continued into H2, thereby creating a twofold challenge for the business. While we achieved 25% growth in volume, revenue from CRGO processing increased by only 10% in the whole year. This, however, reduced the working capital requirement within the segment in H2. Further, we were able to reduce inventory levels and receivables in the CRGO business that freed up working capital and helped us scale and convert sales faster in the EPC business in the last quarter. In total, the company generated a cash flow from operations of rupees 30.1 crores as compared to a negative 33.87 crores in the previous year due to a prudent capital allocation approach. The overall receivables increased to rupees 190 crores in the year versus 78 crores in FY25, resulting from a spike in EPC sales in the last 2 months of the financial year. In Q3, we reported a revenue of 15 crores, and in Q4, we did a substantial revenue of 126 crores. The increased receivables were primarily funded through a modest increase in debt, along with the substantial support from our vendors and creditors. Overall, our cash conversion cycle went down to less than 70 days in FY26 compared to 116 days in FY25, despite entering into a rapidly scaling despite entering and rapidly scaling a new business line. That being said, we also acknowledge the importance of timely execution and disciplined receivables collection in the projects business. We are confident of completing the work on time while ensuring the receivables are normalized in the next 3-4 months. While EBITDA margins within this division hovered around 12%, we expect margins for the remainder of the orders to be between 8 to 10% going forward, discounting short-term war-related supply disruptions and material cost increases. We expect revenue booking of about 100 crores in the existing orders in FY27 and the remaining amount in FY28. We are also actively pursuing business development in the space to fuel growth for FY27 and beyond. Given our existing resources and execution bandwidth, we believe we are positioned to handle additional orders of up to 500 crores alongside our current order book. We are fairly confident that margins are expected to go up as we book new orders. However, we will remain highly selective in undertaking projects after carefully evaluating execution and receivables risk, as this big business segment is still evolving for us and requires a cautious balance between execution and scale up. Transformer manufacturing is evolving steadily, wherein we have successfully delivered our first transformers at customer sites without any reported issues. Annual sales of transformers and allied components were approximately 6 crores, which included transformers, core coil assemblies, tanks, and individual coils. Our approach is collaborative rather than competitive with existing customers. We intend to supply transformers and allied components to our existing customers while also tapping underserved markets within the transformer space. We are targeting rupees 20 to 30 crores in sales from this division in FY27, supported by developmental or export orders in hand and an encouraging momentum in the domestic market. While this business may take some time to gain meaningful traction, we believe that it has potential to become a significant growth driver in the coming years, considering the high demand scenario coupled with our experience and network in the transformer value chain. While we are excited about our new divisions, we are equally looking forward to scaling our CRGO business. With an installed capacity of close to 24,000 metric tons per annum, we are currently operating at a monthly capacity utilization of about 65%, with the most scope for ramping up in power transformer cores. Amid the prevailing oversupply situation, the scale-up is taking longer than anticipated as we are now becoming even more selective in order booking. With the recently secured NABL testing lab certification and PGCIL 765 kV class and NTPC vendor approvals, we anticipate increased order visibility and strengthened customer ties in the power transformer core sales. Our export sales contributed to a little less than 10% of the total CRGO sales, and we expect it to increase marginally in this year. Overall, our objective for FY27 is to maintain a similar volume growth trajectory while focusing on margin improvement. We have completed all the CapEx related activities in manufacturing as planned and on time in the last 2 fiscal years, amounting to about 30 crores, which has the peak potential of manufacturing sales of 500 to 600 crores at the prevailing price levels and 700 to 800 crores if CRGO prices bounce back to previous levels. We do not have major capacity expansion plans in FY27, as our focus will be on improving utilization across capacities. We aspire to grow by keeping return on capital attractive for our shareholders. At a broader level, our strategy will revolve around 2 key principles. First being to evolve into an integrated player in the power T&D sector, contributing substantially to the development of India's electricity infrastructure. And the second would be to allocate capital most efficiently to ensure healthy ROC and ROE metrics that align with investor expectations. With that, I'm happy to answer questions that you may all have. Thank you.
Thank you, Mudit. All those who wish to ask a question may use the option of raise hand and we'll invite you to ask the question. Alternatively, you can also put your question in the chat box or the Q&A box. We'll take the first question from Agastya. Agastya, you can go ahead, please.
Thank you, Vinay bhai. Mr. Agrawal, congratulations. Seems like a decent set of numbers. I missed around first 3-4 minutes of your opening commentary, so I apologize if this has been addressed already. Um, Sir, do you expect the CRGO margins to continue to decline further, or have we hit the bottom in the second half?
So I'll answer this in a way where I also answered the last time around. Again, I believe that the prices have bottomed out, similar to the last time. The last time around, the prices were not going back up, but this time we are seeing that the prices are going back up.
Okay.
One contributing factor is the extreme depreciation of rupee against dollar, because we still are an import dependent country with as far as CRGO steel is concerned. However,
Okay.
Chinese internal demand is also seemingly strong, which is what gives us a signal that the prices are going to increase, probably not drastically, but maybe
Hmm.
there will be some sort of stability going forward.
So what kind of levels do you expect these to settle at? Again, sir, I understand a lot of variables, lot of moving parts, but just your best estimate as of now.
So our best guess is a slight increase, say to the extent of 5 to 7%, not
Okay.
considering the depreciation of rupee, because depreciation of rupee as of today has contributed to a 5% increase itself, right? So
Right.
that put together, if rupee depreciation continues to say level of 100, then it
Right.
might even go up to 10 to 15% increase.
Perfect. Last question from my side. If I look at the EPC business now, uh, I don't have the balance sheet breakup in front of me for that division itself. I have the capital deployed numbers that you have shared in the segmental breakups. But can you give us the working capital deployed in that business so far, and where do you expect them to like this requirement to peak out? So if I look at the trade receivables of one almost 200 crores, so let's say 190 crores, and then you have inventories of 47 crores. So what is the bifurcation here between the two divisions? And similarly for the on the payable side, so if I remove the MSME part, so 122 crores of receivables, again, what is the bifurcation? And how do you see this division in terms of revenue growth also, and also the working capital? How do you, I mean, what are the levels, number of days, let's say, that you expect to see next year in terms of working capital requirements?
So out of a trade receivables of 190 crores, our receivables in the EPC business is to the tune of 118 crores. As
118.
Yeah, 118.
Okay.
As far as inventories are concerned, there is negligible inventory on the books in the EPC business.
Perfect.
Everything is
Perfect.
to the tune of manufacturing business.
Perfect.
With respect to payables, I'm so sorry, I'm not sure of the exact number, but I
Sure.
believe it is around 70 to 80 crores within EPC.
Okay. 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 So 118 crores and 70-80 crores. So, okay. So not that much actually. Do you expect these numbers to hold, or do you expect like industry level numbers going forward?
See, that entirely depends on the kind of order book that we have. So if you just consider the current order book, we will
Hmm.
be able to reduce it quite drastically in the coming few months, because
Okay.
erection portion will gain speed. So right now, what
Okay.
has happened is it is mostly purchase of material and sold it to the end customer. So it is sort of
Right.
like I mean, I would advise you to take it with a pinch of salt as far
Sure.
as the sales is concerned,
Sure.
because erection has merely started. So the main situation that will unfold with respect to the execution part is once we complete a good amount of erection. Once we complete good amount of erection, we will be able to, encash about 30-40% of the receivables.
And in terms of growth, so you are given order booking of 267 crores. So uh, based on this, how much growth are you expecting in the EPC business, plus whatever visibility you have in terms of fresh tenders?
So in FY27, like I said, we are aiming to do about 100 crores
Okay.
within the existing order book.
Okay.
So just to clarify, the order book that was initially received has slightly increased to the extent
Okay.
of 280 crores
Okay.
because of a change in BOQ and some price variation factors. Uh,
Right.
so essentially, what we are seeing is that we will be able to do 100 crores within FY27 and the
Okay.
remaining 35-40 crores in FY28 with respect to the current orders. With respect
Understood.
with respect to new orders, we have some discussions in pipeline. Essentially, the whole issue here is that we don't have a pre-qualification to directly bid in tenders, which
Right.
we are gaining at this point of time. And once we are able to gain that, we will be able to participate in the new tenders. It also
Perfect.
depends on
Okay.
the speed of the decision of the tenders. We are
Right.
interested in doing more of RDSS work, which we currently are also doing.
Understood. Thank you very much for giving me your time. Sir,
Thank
one
you.
small request. If you can move to quarterly reporting, that would be of great help. All the best, sir. Thank you very much.
Thank you. Thank you.
Thank you. We will take next question from Shubh J. You can.
So congratulations on a good set of numbers. I have, sir, just two, three questions. So the first question is that now that the business has sort of revived and H2 was really good, sir, what sort of growth can we look at in FY27, especially if I talk about specifically all three verticals, transformers, EPC, and your core CRGO business?
So, with respect to the CRGO business, again, we are aiming for the same amount of increase as we did last year in terms of volumes. We can't really say about the revenue, which is why I've never guided on revenue part, because we know that CRGO prices can be volatile. It may increase, it may decrease, which might not be the true picture as far as growth is concerned. Which is why we would again like to say that volume growth should come. Since we have already secured 765 kV class approval in PGCIL, we have some order visibility, which might result in the additional increase in volumes. On the transformer front, like I've said, it is going to be a slow increase. It will be an organic increase, however, and the export orders that we already have in hand, that is to the tune of about 1 crore. So once that is developed and supplied to the customer, they will be even more confident to give us more orders. So we have a verbal commitment from the customers for to the tune of about 20 crores as of now with respect to these export orders. With respect to domestic transformer sales, we will continue to supply and support our existing customers for core coil assemblies, for tanks, for individual coils, as well as for transformers if and when required. We are in discussion with some of the customers. They would be willing to use our capacities to further enhance their sales, as transformer industry is going through increased demand. With respect to the EPC business, like I said, we are aiming for 100 crores of revenue from the existing orders, and our balance sheet tells us that we can take up to 500 crores of order booking. If we are able to convert an order booking of 500 crores, or let's say even conservatively 200 crores by the mid of the year, we will again be able to execute at least half of that.
Got it. And sir, now that, in a way, that, as you were saying, that we might have hit the bottom at least in CRGO prices. What sort of margins can we have a look at, like the consolidated margins? Because I think H2 was almost around 7%. So can we see a improvement there next year?
Yes, there will be an improvement. With respect to CRGO, we will see an improvement. But again, like I said in the previous calls, I'm not really sure of what improvements that could be, because currently we are again in a turmoil with respect to the Middle East situation. So right now it seems that CRGO steel is not affected by that. But if there is some extra currency fluctuation, that could again hit margins. So I would be cautiously optimistic on this front. The additional quantities that we are trying to secure within the CRGO business are on a back-to-back basis, which protects our margins.
Sir, I understand, but the margins for the transformer as well as the EPC one would be stable, right? That can you at least tell us what will be the range?
Yeah, so margins with respect to transformers and EPC would be in the range of 8 to 10%.
And sir, the total sales contribution from these two would be how much approximately in FY27?
It's hard to say with respect to EPC because it all depends on the new orders we get. But as of now, it seems about 120 to 130 crores with the current line of information we have.
Got it, got it. So just the last question in terms of
Requesting you to please rejoin the queue, and I request all the participants to limit the questions to two per participant. We'll take the next question from Pawan Kumar. Please go ahead.
Sir, my only question was regarding the EBITDA per ton. When I calculate that number for CRGO, this quarter comes to somewhere around 11,000, 12,000, which even is lower than our Q2 numbers. So, what do we think are the sustainable numbers that we can do here? And if we are getting more into back-to-back contracts, as you are mentioning, what are the kind of EBITDA per ton that we would target in this particular segment while taking the orders?
So for the back-to-back orders, we are aiming for EBITDA per ton of about 20 rupees, 20,000 per ton. But I would like to mention here that the prices have fallen drastically, which is why the fixed cost as a percentage goes up, which is why the EBITDA per ton decreases. On top of that, the gross margin was already decreasing because of raw material prices shifting downwards. So we believe that I have always guided in the past that 10 to 12% EBITDA margin is a good stable level if raw material prices or the overall market is stable. I would like to maintain that if the prices are stable in an unstable environment, I believe this was the lowest that was there to see.
And currently, what would the CRGO prices be? Around 230 rupees, correct?
You mean average realization, sales
Yeah,
realization?
average realization.
Yeah, so it is around 230 rupees.
230 rupees, and we are saying we expect an 5 to 7% kind of increase going forward, right?
Correct.
Okay. So, Mudit, if I wanted to put a question saying last year versus this year, how confident are you about the CRGO business entering this particular year? And also, was there any kind of inventory losses in the H2 part of it or the CRGO business? Because 11,000 looks too low.
So the kind of inventory losses we faced after the end of FY25 was not there to be seen, right? Because we had a lot of inventory on the books, which we streamlined in the first half of FY26.
Okay.
But if the speed of raw material prices going down comes down to, let's say, 15 days, in every 15 days the raw material prices are falling. So then each and every bit of inventory we carry will turn into inventory loss. Does that make sense?
Yeah, I got that. And roughly we are saying in H2 the prices fell by around 15 to 20%, correct?
Correct.
Okay. That is very clear. And now go on the other part,
Sir,
how
requesting
confident
you
are
to
we?
please join the queue. Thank you. We'll take the next question from Siddharth Shah. Please go ahead.
Yeah, hi. Thanks for taking my question. No, I just wanted to understand maybe your strategy around your CRGO volume outlook. I think one of your competitors has, of course, really ramped up volumes north of 60%. But we have, the capabilities to do 400 and 765, which seems to be where a lot of the, new orders will come from. So why are we just targeting 25% volume growth for this product?
We don't see the justification of return on capital if we go quite high on the volume growth, and there will be a substantial price war going forward. We are already seeing new players creep up in the CRGO steel segment. Uh, 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 and we feel that a decent volume growth should justify the business and diversification from there on. We don't see the market wherein we could grow at 50% on an annual basis.
Okay, got it. And just, we spoke about EBITDA per ton, but is it possible to give, for H2 the kind of, cost of goods sold per ton? Because we have the realizations from your segment analysis, but it's tough to get the costs because of now the EPC division in the consol financials.
Just 1 second. I don't think it should be difficult because uh, I think if you look at the purchase of stock in trade, that is the only part that is concerned with the EPC business. So if you just remove that, you'll be able to get COGS.
So when I did that, I got about, say, 230 rupees as the COGS for FY26. Let's just say for the full year, which seemed very high given, people were talking about CRGO in the 185 to 190 rupee range.
Just 1 second. So that must be the COGS you must have calculated would be for the whole year, right?
Yeah, FY26.
And right now, the average purchase price is around 170, 175 rupees.
But this is coming at
So,
230.
Let me check.
Sure.
Let me get back to you on that because according to my calculation, it should be around 210 rupees.
Okay. But
on a full year average basis.
got it. And that's only because there was a 15 to 20% reduction in H2. Is that the
Correct.
reason why our COGS are so much higher than the current market price?
Correct. So I'll tell you, I'll give you a perspective. If I consider my average sale price minus COGS, that has gone down because the raw material prices are going down. But if I consider average sale price minus average purchase price, that has pretty much remained constant if we compare it with FY25.
Got it.
Make sense?
But that purchase price, meaning we'll see that in go forward basis, right? Because that's
Exactly.
not yet, that's an inventory.
Exactly. Which is why we further reduce the inventory levels. If you see, our inventory levels have gone down drastically. The reason for that was specifically to protect margins where the raw material prices were falling, not even on a monthly basis, but on a fortnightly basis.
Got it. No, this is very helpful. Thank you so much.
Thank you.
Thank you. Now we'll take question from the chat from CA Saisha Vora. Sir, the first question is, what are the capex plan for FY26-27?
We don't have any capex plans. We have already installed our capacities in the last 2 years in Unit 2 and Unit 3, wherein we will try to build up capacity utilization. And going forward, after we complete the capacity utilization to the most optimum level, then we may plan for a capex. So at least for FY27, there are no plans.
The second question is, what is the projected sale of IntelliCore in 26-27? Provide little more detail about the product and company strategy going ahead.
So we are projecting about 20 to 30 crores sales in transformers and allied components, I would say, because some of our customers require core coil assemblies, which would not be branded as IntelliCore. So IntelliCore would be just the transformer sales to end users of transformers. That is a difficult number to put there because we will be supplying to export customers. We will be supplying to some domestic customers. But as far as our sales strategy is concerned right now, we are seeing about 20 to 30 crores of sales. With respect to the branding, what we have done here is we want to express to the market, to the consumer, to the buyer that we come with a rich experience of handling the cores, the CRGO cores, which are the critical components of transformers, which is why we have created a brand by the name of IntelliCore.
So the third question is provide details of the first EPC contract received in T&D. What are the projections for 26-27 for T&D segment?
So the order book with respect to the already received orders is to the tune of 280 crores, like I stated, out of which we have completed about 140 crores of sales. And the remaining, out of the remaining work, we will be able to achieve 100 crores in FY27 and 40 crores in FY28.
Okay. We'll take next question from Saumil Shah. Please go ahead.
Yeah, hi. Am I audible?
Hi, Saumil. Yes.
Yeah, hi. Hi. Mudit, when I'm checking our volumes for last year, second half, we did about 6,900 MTPA, whereas current year, second half, we did about 7,800 MTPA. So, what is the reason for that? Even our volumes have not grown. So, are we seeing any demand slowdown along with the price, damage?
You were saying in FY25 second half, we did 6,900, right?
Yes.
And in H2 of FY26, we did about north of 7,500.
Around 7,000, yes, 7,500, yes.
So it has grown, right? On a annual basis, half
Yeah,
yearly basis, but on
yeah,
a YOY basis, it is increased.
yes, yes. It has increased by 10-11%, but I think our capacities have gone up so much. So we have not seen volume increase that much.
Yeah, so Samil, the reason primarily was again related to the raw material price decline. The problem here is that the sentiment of the market actually goes for a toss. Once the prices are declining, there is an overall negative sentiment within the market, and the all the competitors are aiming for price war and trying to get rid of the higher price inventory, which leads to even further price reduction. And so what we did was we tried to cut down on the growth while protecting margins, which is why we did about a sizable volume, but we were not fully utilized with respect to capacity.
Mm-hmm.
Also another factor was that we were restricted by our aim to get PGCIL approval in the 765 kV class. We had actually planned to get it in the fourth quarter of the year gone by, but it actually came in April. So now we are gearing up for those kind of orders.
Okay. Okay. And so basically for this year, you said the average price is about 230 as of now?
As of now, on a monthly basis, yes.
On a monthly basis. Okay. And what was this for last year, second half?
Last year's second half. You mean FY25?
I mean FY26, this March quarter, what was it?
Just 1 second. Yeah, so March Q4 was around 227.
Okay, and it is hovering around similar levels as of now.
Yeah, and Q3 was around 250.
250.
Yeah, so between Q3 and Q4, there was a huge fall.
Okay, understood. And now you are seeing, price revival and demand pickup. So from here on, can we see an increase in the EBITDAs per ton?
So two components to that. We are seeing that the prices of raw material are increasing, like I previously mentioned. The demand within China seems strong, and the Chinese suppliers are also not willing to reduce any further. But the second component here, with respect to, like you said, demand, is that the demand is structurally strong. However, because of shortages of raw material with respect to the recent inflation in prices. So, for example, aluminium and copper have gone up significantly. Transformer oil has become really short in supply because of oil difficulties. Because of that, we are seeing short-term difficulties in supply chain with respect to transformer procurement at the customer end. So that slightly might affect volumes, but in a longer run, we don't see any problem with respect to the structural demand.
Okay. And my second question is in with respect to our EPC orders, just wanted to know more about it. So what are we doing? I mean, so are we utilizing any of our manufacturing capacities for our EPC orders, or it is just a trading business?
So it's not a trading business, it's engineering, procurement, and construction, wherein we do all the work back to back for our customer. Currently the work that we are doing is augmentation, revamping, and installing new lines in the distribution 11 kV lines in Haryana and Punjab. Wherein we have to procure materials, which includes conductors, cables, transformers, and allied parts, and we have to install them and erect them. So currently we are in the procurement stage, and slowly and gradually we are now moving into the erection phase. So once erection happens, the project stands completed.
Okay. So basically, none of our manufacturing facilities will be utilized, no, for this.
In future, it will be utilized with respect to captive consumption. So, transformers will be required in these projects. We will be able to supply our own transformers. As of now, we are not able to do that because it requires uh, 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 end customer approvals, which we currently don't have.
Okay. That's it from my side. Thank you and all the best.
Thank you.
Thank you. I would request Bajrang Bafna to unmute and ask his question since he is unable to raise hand.
Participant.
Bajrang?
We'll go to the next participant, Mr. Sunil Bansali. Please go ahead.
First, Mudit, congratulations on your good result. I'm CA Sunil Bansali from Chennai. I have few questions and few suggestions. First, we are not getting monthly update. First is quarterly result. I think you are moving toward that, but till that is not happening, can we move toward the monthly update of the sales and order book? Is this possible?
We can consider that. Let me discuss with our team, and probably we'll consider it.
Because it will help investor very greatly, because otherwise if we get figure in 6 months, it is very difficult to track the company. So my suggestion is, because wherever I was associate, generally we were doing this one, so investors can project and can have the good feeling also, and it helps the company in long run. Second, I just want to check, you are saying that your raw material is too much volatile, prices since we are getting the order in advance, and generally I was working, generally we were hedging raw material with this sales order. So because your orders are in advance, so you are procuring raw material against that. So why it is so much fluctuation in raw material in margins? I'm not able to understand. Can we do some mechanism? Because I work with all Hero Honda and all those. There we were having stable margins. Okay, little bit here, there, maybe there. But because of orders are in advance, we are not getting orders later on. First, we getting the order. I think our order book is quite okay. So can we not hedge the raw material along with the order? As soon as order come, we procure the raw material for that order, so our margins are stable.
So our order book is generally 1 to 2 months at the max. We are, like I said, with respect to going into higher segments of 400 and 765 kV class, we are aiming to get more visibility of orders. Right now, since order books are not more than 1 to 2 months, it becomes very difficult with respect to planning. And since the environment of raw material price decrease continues on a consistent basis, then the customers also become quite prudent of that, and then they stop order commitments, and they would eventually want to book orders at the lowest price possible, wherein we might carry some inventory which is at a higher price. So it's not as simple as maybe an auto ancillary company would be, because there are a lot of grades. Each and every order might be different. It is not simply that we have a contract with a customer and continue executing for a longer period of time.
Then I can understand that one, but you see our competitor, nearest competitor, Villas, they are having far better margin than how they, if they can maintain, we can at least can come nearby of that, na? Because if you see our difference of the margins, we are having two big difference with Villas. And you see how we can improve the margin. It is my suggestion only, because my thing is how we can protect our margin so that in long run, we can have the better working and investor are good rewarded. It might suggest only you work out. You are better in position, but just I am giving suggestion because you see our competitor also. Because their margins are far better than this, and this is not for 1 month or 1 quarter, or it is consistently their margins are far better than us. Or otherwise, they are as per you, they are having far better technology than us or far better product than us. So because of that, this is happening, or we are par with them, or we are better than them. So we can also catch up those margins.
So I would definitely not like to comment on my competitor, but I have already said in my opening statement, the CRGO steel processing business is largely a non-differentiated nature of business. So there is no technology difference, no product differentiation as such, which could contribute to huge difference in margins. The whole industry suffered in the last 1 year. Whoever was the purchaser of CRGO steel with respect to the processing business, as well as the steel mills who were probably competing with the Chinese steel mills. So we going forward, we take your suggestion, and we will definitely look at improving our margins.
Sure. Thank you. Bajrang has unmuted. Bajrang, you can go ahead, please.
Congratulations for a good set of numbers this quarter. Hope I am audible, sir.
Yes, you are audible.
So just to recap, probably I might have missed a couple of things in the con call. So the volume was 7,500 tons in S2. So what you said that there will be some growth in volume in FY27, and of course I understand there are certain problems that are already there because of this West Asia crisis right now. But at least what visibility that you have right now, considering the order book and the system things, what sort of volume growth you are guiding for FY27? To be precisely within some band. If you don't want to give any utilization number, you can give me some band which will help us to model in our numbers, sir.
So based on the orders that we are in the process of securing, we believe we will be in the range of 16 to 18,000 tons. So if the prices are stable or even going up, we would be aiming for north of 18,000 tons. If the prices are continuing to be unstable, or let's say again they take a reversal, we would be eventually ending up above 16,000 tons.
Got it, sir. And you have also given some number on EPC and transformer. I might have little bit confused. You have given 120 to 130 crores. Is it EPC or it is including transformer?
So 100 crores of that is EPC, and 20 to 30 crores we are aiming for transformer business.
Okay, that's true. But sir, you are currently entering in the white labeling segment, right? In transformer, you are manufacturing for others. So how the transformer segment you really want to cater to, people like PGCIL and all those companies, or will keep doing the sort of job work for already existing players? So if you could just elaborate your strategy, maybe from next 2 to 3 years perspective, because when we talk to these transformer people, they are saying for next 5, 6, 7 years there is a humongous demand which is existing in the system, and we all are sort of supply. So if you could just elaborate on that, how do you see your positioning maybe from next 2 to 3 years perspective?
So like I said, we do not want to become our customers' competition. The idea is to support them in their efforts to increase their sales and profitability, which will eventually help us in the CRGO business also. Having said that, we are also looking at increasing our sales to end consumers of transformers. That will take time. That will eventually take time. This was the fastest way of scaling up our business and making sure the return on capital is generated in the fastest possible manner.
Okay, so considering all those what we said right now, this 500 crore sort of revenue is possible in FY27. That's what my broader calculation, assuming 230 rupees realization for CRGO right now, and assuming 17,000 volume. Will we be able to do margin somewhere between 8 to 10%, in FY27, all console put together?
Your revenue number is correct. Yes, probably we will be above that. With respect to margins, yes, we are seeing those levels. Those levels are achievable. 8 to 10% is achievable.
Got it. And sir, just my last question on the working capital cycle. On a console basis, like different segments have got different working capital cycle. So if you could just guide us, how do you see the funding of working capital, whether you will be tilting more towards debt or probably, how you're going to fund that working capital thing?
So we have currently we have been able to reduce the working capital requirement in CRGO and use that to fund our EPC business and some support from the vendors in the EPC business as well. Going forward, if we are only executing the existing orders, we don't need additional working capitals. Probably the figures will even improve from there on. If we are able to secure more orders, we will be funding it through debt.
Okay. Okay. And net working capital cycle will be better than what we are having right now, correct?
Expected to be in the same range.
Okay. Got it, sir. Thank you and all the very best, sir.
Thank you so much.
Thank you, Bajrang. We'll take a few questions from the chat. One is from Mr. Nitin Batra. Are the land and building for all three units owned by the entity or are the units on lease?
So Unit 1 is owned by the company and Unit 2 and Unit 3 are on long-term leases.
There's a question from Aditya Butra. What is the capacity utilization for manufacturing in FY26 and how much do you expect in FY27?
Capacity utilization comes out to be about 65%. However, some part of the capacity enhancement took place in the middle of the year. So on a full year basis, it comes out to be about 65%, and that is pretty much the number that currently holds true with respect to monthly utilization. Sorry, Vinay, what was the second question?
That was it. And for FY27, what will be the capacity utilization?
So, like I said, we have a scope of going up to 21,000 tons if we consider everything as idle. But the aim in this financial year would be to protect margins, and we will be selective in order booking. So, which is why I said we are aiming for conservatively 16 to 18,000 metric tons of volume in FY27.
There's a question from Deepak Gugnani. What is your vision for FY28-29? Do we have any internal target or guidance for scale or market share or products? And by when should we look at getting on the main board?
The long-term vision again remains that we want to become an integrated power player wherein we do EPC projects. We see a lot of scalability there as well as profitability. However, it is a working capital intensive business, so we have to take a calibrated approach. The manufacturing part will eventually be used also to successfully increase margins in the EPC business. So we see synergies in all three businesses put together, which is where we want to take the business forward. If we are able to see demand coming through in the next 2-3 years, we will be going for a full-blown capex with respect to further enhancing the capacities.
There's a question from Gautam Karmarkar. Do client contracts have price fluctuation pass-through clauses? And what's the industry trend for this product category, that is CRG cores?
Uh, the orders that we generally have do not have a pass-through mechanism. We generally get orders on a spot basis in the span of 1 to 2 months. However, the orders that we are discussing with our new customers would have some pass-through mechanism and would entail protection of margin. While it may not be a high margin, but there would be protection of margins.
Sure. We'll take next questions from participants who've not had a chance to ask a question. We'll first take it from Nishita. Nishita, you can go ahead and ask your question.
Yes, hello, am I audible?
Yes.
Yeah, so I just wanted a clarification. You mentioned that right now the average purchase price for CRGO is 170 to 175 rupees. And then you also mentioned that it's at 230 rupees. So just wanted a clarification. The current price is at 230 rupees, right?
Correct. Average sale price.
Okay. And the 5 to 7% price hike, excluding the rupee depreciation, we can see happening, right?
Correct.
Okay, okay, understood. And also a clarification on EBITDA margin. So, in CRGO, we have EBITDA margin of 10 to 12%, which will be sustainable for FY27 as well.
See, the volatility in the past 3 periods has been so detrimental to the business. We don't want to guide on an EBITDA margin level. In the previous call as well, we never guided on the EBITDA margin level. We just want to give you as we basically want to give the investors a real picture, a true picture of what is happening in the industry, and hopefully be able to ride through the storm and get through better margins. We are confident of going back to those levels of margins if the prices go up, as well as there is some form of stability in the market. So if let us have at least one more period wherein the stability remains. Once that is there, we will be able to confidently guide on the margins.
Okay, okay, understood. But like just to understand, if things are stable, then 10 to 12% margin is what we can see.
Absolutely.
Okay, okay. And in EPC also the margin is around 10 to 12% or it's lesser?
So we are currently aiming for 8 to 10%. Right now, if you notice the books, it was hovering around 12%. But just to be on a conservative side, we think that 8 to 10% level in the existing orders is sustainable. Uh, with respect to new orders, there will be an improvement of margins.
Okay, okay, understood. Thank you so much.
Thank you.
Thank you. Since we have hard stop at 1 p.m., requesting all the participants to restrict to one question. So we'll take next question from Prashant Somani. Please go ahead.
Good afternoon, sir. My question was regarding the EPC business only. What kind of order pipeline do we have for the coming years? New orders, which we are expecting or bidding for that? And what kind of capabilities we have built for this, which helps us in competing with the larger players? Because what I know is the current execution is mostly outsourced to the other vendors.
Which is one of us. I mean, the execution was outsourced to us, right? Because these orders that we got were subcontracted to us. Right now, we don't have visibility on the order book,
Okay.
but we will eventually be going for some sort of business development in this space, and hoping that we will be able to secure some orders in this financial year. Like I said earlier, that we have a bandwidth to handle orders of about 500 crores with respect to both working capital as well as the team size that we have. But it will obviously depend on the kind of margins that it entails and the risks involved in it.
Thank you. We'll take next question from Sarthak Gupta. Please go ahead. Yes, Sarthak. We'll move on to Ayush Marwa. Please go ahead.
Hello. Hello.
Yes,
Yes,
you're
sir.
audible.
Yeah. What will be the future product mix in terms of revenue from all the segments combined?
So what we are aiming for is 50% of our revenue coming from EPC. That will be the ideal situation. However, at this point of time, it is difficult to give a number because we don't have specific orders in hand.
Okay, and won't the EPC affect the cash flows, and how will you mitigate that?
Yeah, so EPC will eventually be a working capital intensive business. We will be selective of the orders that we take, and our team is, I mean, we have confidence in our team to make sure that the receivables are received on time.
Okay, fine. And one last question. What is the guidance on each vertical, if I may ask?
Uh, are you specifically asking for FY27?
Yeah. Yeah.
Yeah, so FY27, the increase in volumes will come through in CRGO as long as the margins are protected, because our focus will be on margin protection. So we are not seeing a substantial increase, but we will try to achieve the existing growth rate. On the EPC front, we will continue to do about 100 crores of business with respect to the current order book, and hopefully bid for new orders. With respect to transformers, we are aiming to do a sales of about 20 to 30 crores.
Thank you. We'll take the next question from Sanjay K. Sanjay, you can go ahead and ask your question, please.
Hello, am I audible?
Yes,
Yes.
you're audible.
Hey, well, what is the execution and collection cycle for the EPC that you're projecting for the year?
So, mostly the payment terms in the current orders, especially with respect to the RDSS orders that we have, is 60% of the material cost is 60% of the billing is realized upon delivery, and the remaining 40% is executed or say realized at the time of erection of the feeder lines. So the 40% that remains will eventually be realized once erection goes through.
We'll take the next follow-up from Shubh. Shubh, you can go ahead, please.
Sir, so I just have one question. Like, as a long-term shareholder, what I would want to understand is that where do we see JB in next 3 years? I mean, what I've seen in last 1 year is that, sir, we have diversified into two more verticals. We were doing CRGO, and now I think you also mentioned that we are intentionally not increasing the utilization because the ROC doesn't make sense at some point, right? So where do we see JB in next 3 years, and how do we see the growth, overall growth, right? At least in next 3 years, like, is there any aspiration to reach 2000 or some sort of a revenue or anything that you can give us and tell us what is it that JB is going to be specialized in at some point of time?
It will be a mix of both manufacturing and services. Services, when I say services, it means projects. The vision, like I said earlier, is to become larger with respect to scale. We want to hit the 1,000 crore mark as early as possible. We have some internal projections, but it will be difficult for us to comment on that right now, considering that we are recovering from a bad cycle in the CRGO space. So I would suggest give us some time to build on the capabilities in the new divisions that we have created. Let us prove that we are able to execute those divisions effectively with respect to return on capital, and you will eventually see that we are scaling up nicely in all three segments.
Sure. Since that was the last question for the day and we need to close the con call, Mudit, would you like to give any closing comments?
Yeah, I just want to say, I would like to thank our long-term shareholders who have been extremely patient and trusting in us. We've had our ups and downs, but eventually, in the long run, we want to build a business which is sustainable and organic in the growth of sales as well as profits. So thank you, everyone. Thank you for joining this call. And again, lots of thanks to the long-term shareholders who are with us through thick and thin.
Thank you. Thank you to the management team for your valuable time, and thank you to all the participants for joining on the call. This brings us to the end of today's conference call. You may all disconnect now. Thank you.